Okay, so how does the analyst use the cash flow statements? Well, what the cash flow statement does is it reconciles between last year's balance sheet cash figure and this year's balance sheet cash figure, and it explains why it's changed. So it shows you the sources and uses of cash. So very useful, therefore, for our analyst, because it shows, do our day-to-day business operations generate sufficient cash? Do we generate sufficient cash to pay off liabilities, i.e. debt instruments, when they fall due? It will highlight the need for additional financing, and also it shows us whether we have the flexibility to meet unexpected obligations and business opportunities, i.e. projects. Now, our first LOS asks us to compare and classify items in our three categories: cash flow from operations, cash flow from investing, and cash flow from financing. So taking cash flow from operations first, you can see that cash flow from operations is just showing you all the cash flows that you've received from your day-to-day business operations, less all the cash flows that you've spent on your day-to-day business operations. So the cash collected from customers, dividends received, interest received, any other cash income like rentals, etc., payments to suppliers, cash expenses on your day-to-day business operations like wages, like rents, like audit fees, etc., any cash interest paid, and also cash taxes paid. Now notice this is actually under US GAAP. Notice the oddity here. We've got dividends and interest received, we've got interest paid, but not dividends paid. That's because under US GAAP, dividends paid will go through cash flow from financing. Cash flow from investing is really any cash spent acquiring our long-lived assets and any cash received on the disposal. So typically it's going to include cash spent on PP&E, cash spent acquiring equity and debt in joint ventures, affiliates, cash spent acquiring subsidiaries, i.e. businesses acquired. It also includes the cash spent on certain marketable securities. Those marketable securities are the held to maturity and available for sale ones. Not trading though. Trading securities go through cash flow from operations. The reason for this is, if you hold trading securities, you're likely to be a financial institution, and as a result, buying and selling trading securities is part of your day-to-day operations, and hence they should go through CFO. Notice it's not only the cash spent, but it's also the cash received on the disposal of any of these long-lived assets as well. Notice cash equivalents, so these are money market instruments with maturities of less than 90 days. These are not included within your CFI. Why? Because they're included in the balance sheet cash figure that we're trying to reconcile. So actually we're not reconciling between last year's balance sheet cash figure and this year's. We're actually reconciling between this year's balance sheet cash and cash equivalents and last year's cash and cash equivalents. Cash flow from financing is going to include any cash raised when we issue equity, so that's common stock and preferred stock, any cash spent when we redeem equity, when we buy back equity, so treasury stock, any cash raised when you issue debt, and any, of course, it will include outflows representing the principal payments on debt. Remember, not interest payments under US GAAP because those go through CFO. The other one, and remember this is the oddity under US GAAP, dividend payments go through cash flow from financing under US GAAP. Notice it excludes indirect financing via your accounts payable. Your accounts payable, well, let's just think about this for a second. You could finance the company by delaying payments to your suppliers, in which case your accounts payable would increase over time. Now that would affect cash flow from operations, not cash flow from financing. Our next LOS asks us to describe how non-cash financing and investing items are reported. Well, we're talking about investing and financing items that do not result in the payment or receipt of cash. And if they don't result in the payment or receipt of cash, they're not going to appear in the cash flow statement. But they will be disclosed in the footnotes to the cash flow statement. So let's have a look at some common items. Well, if you've got convertible debt and convertible preferred stock, when they're converted into equity, of course equity changes but no cash is received. If you've acquired an asset under a capital/finance lease, again your assets have increased but you of course haven't paid all the cash out up front. If you've acquired assets via the exchange of equity and debt, again the assets have gone up, your debt's gone up but no cash has been paid or received, so again a non-cash item. Barter transactions where we exchange one non-cash asset for another, again, no cash involved here. And then finally things like stock dividends and stock splits where the number of shares are changing but no new cash is raised. Our next LOS asks us to contrast US GAAP and IFRS. Now notice US GAAP here is far more prescriptive than IFRS. It tells you where all the cash flows will go. IFRS has far more flexibility, allowing you to report economic substance. So let's just take each item in turn. Interest received, US GAAP says treat it as a CFO. IFRS says if interest received is part of your core business operations, because maybe you're a financial institution, put it in CFO. If interest received is rather an odd outside your core business operations, it makes sense to put it in cash flow from investing. Interest paid, again US GAAP says always treat it as a CFO. IFRS says if paying interest is part of your core business operations, maybe you're a retail bank, then put it through CFO. If it's not and it's more to do with the financing of the company, then put it through CFF. Dividends received, well again, exactly the same as interest received. So US GAAP says CFO, IFRS says if receiving dividends is part of your core business operations because you're a financial institution, then put it through the CFO. If it's not and it's really sundry to your core business operations, then put it through CFI. Dividends paid, this is the real oddity under US GAAP. Notice payments to the providers of finance are split, payments to debt holders through CFO, but payments to equity holders through CFF. It doesn't make no sense. So dividends paid through CFF under US GAAP, notice IFRS gives you the choice CFO or CFF. Taxes paid then, all tax goes through CFO under US GAAP, however under IFRS we can split it. Taxes on our key business operations, they go through CFO. Taxes that result from the disposal of assets would go through CFI, and any tax to do with financing items such as maybe early retirement of debt, etc. would go through CFF. US GAAP, bank overdrafts are treated as a debt instrument, so they go into your CFF. However, under IFRS, bank overdrafts are deemed to be just negative cash, and as a result they affect cash and cash equivalents. So they're in the figures you're reconciling between, not in CFO, CFI or CFF themselves. Our next LOS asks us to distinguish between the direct method and indirect method of computing cash flow from operation. The direct method, and we saw it really back a few slides ago, takes each item and shows it as a cash inflow or outflow for your operations. So it shows the cash collected from customers, cash paid to suppliers, cash paid for by wages, etc. So it's very useful for the analyst because they can see exactly how the company generated and spent cash in its business operations. And general rule is the direct method is encouraged by the standard setting bodies. The indirect method, though, is typically how most companies report their CFO. Now, I think of the indirect method as a cheaty shortcut to the direct method. What you're going to do is start with net income and then strip out any non-cash items. Now, it's quite useful in as much as it focuses the analyst's attention on net income and cash flow from operations and why they differ, i.e. all of the non-cash items. And the basic rule is non-cash items in the income statement reduce the quality of a company's earnings. Also quite useful because analysts tend to use the indirect method to calculate CFO and then use it within free cash flow computations. So indirect method used typically by companies. So let's then have a look at our next LOS, describe the linkages between the financial statements. That's the balance sheet, income statement and cash flow statement. And this is going to be quite useful because it's going to show us also the methodology that we're going to be using when we look at direct and indirect methods as well. So let's turn our attention to our accounts receivable T account. Now our T account shows the amount brought forward from last year's balance sheet, the amount carried forward in this year's balance sheet. We could lift the sales figure from this year's income statement. Now, if no cash was collected from customers, we would of course expect the amount carried forward to be 218,000, but it's not, it's only 20,000. So why is it only 20,000? Well, because 198,000 must have been collected from our customers. Now note we could do this a little bit quicker by simply taking the sales figure and deducting the change in the balance sheet item. So the balance sheet item is accounts receivable, it's increased by 2,000, increase in a balance sheet item we will deduct, and I'll explain why in a little while. So 200,000 minus 2,000 gives us 198, the cash collected from your customers. Now our next LOS asks us to describe the steps in the indirect method. And we're going to actually describe and demonstrate these steps to you by working a large example for you. Now what we've got here is an income statement for the current year, X9, and we've got balance sheets for X8 and X9, and we're going to compute cash flow from operations and the entire cash flow statement using the indirect method. Notice we've got some additional information here. We purchased equipment for 50,000 and our tax rate was 40%. So here's our income statement that we're going to be using. And here is the assets from our balance sheet for X8 and X9, and here are the liabilities and equity. And we're going to be constantly flicking between these. Now, we've got some general rules here. An increase in an asset represents a cash outflow. Why do assets increase? Because you've normally spent cash. So if your accounts receivable have increased or inventory is increased, it uses up inventory, and of course that represents a cash outflow. Whereas a decrease in an asset represents an inflow. If your inventory is dropped, it must be because you've made sales, and sales will ultimately lead to cash inflows. Note it's the other way around with liabilities and equity. An increase in a liability represents an inflow because you're delaying payment, so you're keeping hold of your cash. Whereas a decrease in a liability is going to represent an outflow because we know that liabilities represent the future transfer of benefits from our company. So if liabilities have gone down, it means benefits have been transferred out of our company, i.e. we paid them off using cash. Okay, so let's have a look at our indirect methodology here. We're going to start with net income. We're then going to adjust for any changes in relevant balance sheet items. Using the rule, an increase in a balance sheet asset should be deducted because it's a cash outflow. An increase in a balance sheet liability should be added because it's a cash inflow. A decrease in an asset should be added because it's a cash inflow. And a decrease in a liability should be deducted because it's a cash outflow. Now we're going to need to eliminate depreciation and amortization because under the indirect method we start with net income, and that means they've already been deducted in arriving at this figure. But they are non-cash items, so we're going to have to add back depreciation and amortization in order to eliminate them. We're also going to need to eliminate the gains on disposal by deducting them, and essentially if we've got any losses on disposal by adding them back. So these are the disposal on assets. So essentially we're saying number one, these are non-cash items, and number two, even if they were a cash item, they'd be a CFI, not a CFO. So we need to eliminate a loss by adding it back. We need to eliminate a gain by deducting it. Okay, so let's start with our net income. First thing we're going to do here is add back our depreciation. So into the income statement, you can see that this year's depreciation expense was 14,000. It's been deducted in arriving at that 75,000, but it was not a cash item, so we'll add it back. The other major non-cash item that we've got in our income statement here is the gain on sale of PP&E of $20,000. So our net income is $20,000 higher as a result of this gain, but this gain is not a cash flow, and it's certainly not a cash flow from operations, so we need to subtract it, 20,000. Now I'm going to turn my attention to the top of my income statement, and that of course is sales. And I'm just going to go into my balance sheet and hunt for any asset or liability that relates to sales. So I'm in my assets, and the first one I see are accounts receivable that of course relate to sales. Was 18,000 last year, 20,000 this year, so that is a $2,000 increase in an asset. Increase in an asset, we of course deduct. The only other thing that you might see relating to sales is a liability for unearned revenues. Remember, that's when your customer pays you in advance. Okay, here we don't have that, so the only thing we need to adjust for is accounts receivable. So I move to the next line in my income statement, which is cost of goods sold. Now typically there's always going to be two adjustments to make. First of all, we're going to adjust for inventory. By doing that, we move from cost of goods sold to purchases, and then we're going to adjust for accounts payable, and by doing that, we move from purchases to cash paid to suppliers. So let's start with our inventory. Inventory was 14,000 last year, 10,000 this year, 4,000 decrease in an asset we shall add. So that takes us to purchases. We now need to adjust for accounts payable, which is sitting in our liabilities. 10,000 last year, 18,000 this year, 8,000 increase in a liability we will add. and we've dealt with our cost of goods sold. So down to the next line, and our next line is salaries. So included in our 75,000 was an salary expense of 10,000. We now move into the balance sheet to look to see if there's any asset or liability that relates to salaries. And there is. Ours is salaries payable. 16,000 this year, 9,000 last year. 16,000 last year, 9,000 this year. You've got a $7,000 decrease in a liability. Decrease in a liability represents a cash outflow, so let's deduct it. 7,000. We've dealt with our salaries. Next line is depreciation. We've already added that back, so we can move down to interest. So in our 75,000 there's an interest expense of 1,000. Into the balance sheet to look if there is anything relating to interest. And there's an interest payable liability. 6,000 last year, 7,000 this year. So notice this year the liabilities increased by the same as the expense, indicating presumably we haven't paid anything. So we've got a $1,000 increase in a liability, let us add it. So that's our interest dealt with. The gain on sale of PP&E, well, remember it was a gain, so it increased our net income, so we then deduct it to eliminate the item, and we did that earlier. So we then come down to our final item in the income statement, which is our provision for taxes. Now, the provision for taxes in the income statement is made up of two things, essentially. It's made up of tax payable and change in deferred tax. Now, if you've got an increase in a deferred tax liability, that increases the tax expense. Increase in a deferred tax asset, that decreases the tax expense. Even once you've got tax payable, it doesn't mean you've paid the tax authorities yet. So in fact, let's have a look at those two items. You can see in your current liabilities there's tax payable, 8,000 last year, 10,000 this year, increase in a liability of 2,000, so let's add it. The only other thing we need to adjust for are deferred tax assets and liabilities. A quick check of assets, can't see any deferred tax assets. Quick check of our liabilities, and yes, we can see one sitting in our non-current liabilities. 30,000 last year, 40,000 this year, $10,000 increase in a liability, so let us add. And we've arrived at the bottom of the income statement. So all we're now going to need to do is add these items up. And when we do that, we get our cash flow from operations is 85,000. In a few slides time, we'll have a look at computing CFO from using the direct method, and we'll see we'll still get 85,000, just arrive at it slightly different way. So our next thing that we need to be able to compute is our cash flow from investing. Cash flow from investing essentially is the cash that we spend acquiring assets minus the cash we receive on the disposal of assets. Now, bear in mind the net book value of an asset is the asset's gross PP&E, which is just really cost, minus the accumulated depreciation, which is a running total of what's been charged through the income statement to date. So therefore, the gain or loss on the sale of an asset that we see in the income statement are the proceeds received minus the net book value, i.e. the carrying value of the asset at the time of disposal. So what that really tells us is if the carrying value of the asset is bigger than the proceeds, the accountants will record a loss in the income statement, whereas if the carrying value is smaller than the proceeds received, they'll report a gain. Now the idea here is if we know the gain or loss on the disposal, because that's in the income statement, if we can compute the net book value of the asset disposed of, that will allow us to work out the sales proceeds. And of course the sales proceeds are the cash received on the disposal of the asset. Those are what affect our CFI. Okay, so first of all what we need to do is work out what the carrying value, i.e. the net book value of that asset that we've disposed of was. So we've got gross plant, property and equipment and accumulated depreciation here. So when we turn our attention to our data, notice I put in our beginning PP&E. That's just the cost of the PP&E at the end of last year, beginning of this, 282, and we've got the ending PP&E, 312,000, which is the closing figure in this year's balance sheet. Now remember, back on slide 105, we were told that the company had made additions of 50,000. So, for example, if there was no disposal, therefore, we would expect the gross value of our ending PP&E to be 232,000. But it's not. It's only, not 232,000, 332,000. But it's not. It's only 312,000. What must be the difference? Well, it must be, therefore, the cost, or if you like, the gross value of the PP&E we've disposed of. Let's do exactly the same with depreciation. So last year's accumulated depreciation, i.e. opening accumulated depreciation this year was 80,000. Closing accumulated depreciation in this year's balance sheet is 84,000. The depreciation expense we can lift from the income statement. Now the depreciation expense in the income statement was 14,000. So if there had been no asset disposal, we would have expected the ending accumulating depreciation to be 94,000. But it's not, it's only 84,000. So the balance must be 10,000 of depreciation on the asset we've disposed of. The accumulated depreciation, therefore, on the asset we've disposed of. We can then compute the net book value of the asset we've disposed of by taking the gross value of the asset disposed of and subtracting the accumulated depreciation. So 20,000 minus 10,000, the asset we disposed of had a carrying value of 10,000 at the time of disposal. Now we know its value, we can work backwards from the gain or loss in the income statement to work out the sales proceeds. Now the gain or loss, of course, we had a gain on disposal of 20,000. We know that the carrying value of the asset disposed of was 10,000, and therefore the proceeds must have been 30,000. We've got everything we need to compute CFI now. We know the additions represent an outflow, the sales proceeds represent an inflow. So we spent 50,000, but we raised 30,000 on disposals. So overall, we've got a net outflow of 20,000 for our CFI. Okay, let's have a little look at a quick example just to see if we can compute this. Acme Corporation bought an asset for 72,000, depreciation expense was 15,000, accumulated depreciation increased by 5,000, and gross PP&E increased by 32,000. If a gain on the asset sold during the year was 13,000, what were the sales proceeds? Okay, now the sales proceeds should be 43,000, but let's talk you through how we got to that answer. So first of all, we need to work out the gross value of the asset disposed of. Now notice it says we bought an asset for 72,000, but gross PP&E only increased by 32,000. Now of course, if there was no disposal, we'd expect the gross PP&E to change by 72,000, but it didn't, it changed by 32,000, so the difference must be 40,000, the gross value, i.e. the cost of the asset that we've disposed of. Let's do the same for accumulated depreciation. The depreciation expense in the income statement is 15,000, but accumulated depreciation is only changed by 5,000. The difference must be the accumulated depreciation on the asset disposed of. So we now know both the cost of the asset and its accumulated depreciation. So, therefore, the asset's net book value, cost minus accumulated depreciation, it must have been 30,000. Now we know that, we can work backwards from the gain or loss in the income statement to work out the proceeds. So if the gain was 13,000 and the net book value was 30,000, then of course the sale proceeds must have been 43,000. Remember, 43,000 proceeds minus net book value gives you the gain or loss. Our last little calculation is to compute CFF here. Now, the computation of CFF, we'll need to pick up the change in debt, change in equity, and any cash dividends paid. Note with cash dividends paid, sometimes we need to be a detective because it's not in the balance sheet and it's not in the income statement. Remember, it would show up in your statement of changes in stockholders' equity. Now, if we haven't been given the statement in changes in stockholders' equity, we will have to work out what the dividends proposed were. It's relatively straightforward to do this because retained earnings would change by net income if there was no dividend. If a dividend has been declared, then retained earnings will change by a smaller amount than net income. So the difference between net income and the change in retained earnings represents the dividend declared. Once we've got the dividend declared, of course it doesn't mean it's been paid, so we'll need to adjust for any balance sheet asset or liability, or typically liability of course, to get our cash paid. So let's compute CFF for Eccleston. First of all, the change in debt. This is going to be very straightforward. We're going to very much simplify it in our exam. All we're going to do is look at the balance sheet debt this year and the balance sheet debt last year. Now be careful because you need to look at current liabilities as well as long-term liabilities. Current liabilities, remember, can include the current portion of long-term debt, and they can also include things like notes payable. Okay, let's have a quick look at this then. In our balance sheet, which I've temporarily lost, oh no, found it again. Our Non-current liabilities included bonds, and last year they were 20,000, this year were 30,000. So we're going to assume that that change is all due to cash, 10,000. Notice there's nothing in our current liabilities relating to debt. Common stock. Now really we should be looking at common stock and additional paid in capital. Last year there were 100,000, this year it's only 80,000, so we're going to assume a repurchase of 20,000. Cash dividends paid, we're going to have to be a detective here. Net income for the year was 75,000, but if we look at the balance sheet, retained earnings last year was 60,000, this year they're 118,000, so they've changed by 58,000. The difference between net income and the change in retained earnings, of course, is the dividend declared of 17,000. Now I'm putting my dividend declared as a bracket to indicate it's a negative figure. It's rather like an expense. Need to put it as a negative figure, otherwise my adding and subtracting of changes in assets and liabilities won't work. So into the balance sheet now to see if we've got any dividends payable. Into our current liabilities, yes we have. 2,000 last year, 12,000 this year, an increase in a liability of 10,000. So let's add that, and therefore the dividend that was actually paid was 7,000. So we can compute our CFF now as 10 less 20 less 7. So overall, a 17,000 outflow on our cash flow from financing. Now let's put this all together. Our CFO was 85,000, our CFI was 20,000, and our CFF is 17,000. Now that therefore allows us to look at the increase in cash by adding them together. So 80 less 20 less 17 gives us a change in cash of 48. Now we should be able to prove this by looking at our balance sheet cash figures. Now cash last year in the balance sheet, so turn to your assets, cash last year, I'm sure I'll find my assets somewhere. Yes, cash last year was 18,000, whereas cash this year is 66,000. And notice last year's cash 18,000 plus the change in cash for the year 48,000 gives us the closing cash that we find in the X9 balance sheet. So what we've just simply done is reconcile between this year's and last year's cash figures. Now our next LOS asks us to be able to convert between an indirect cash flow statement and a direct cash flow statement. So of course all we're really going to do here is compute the direct cash flow statement. Now what we're going to do therefore is lift the income statement item and then adjust for anything that's affected the income statement item due to the accruals process. So we'll take, for example, net sales, i.e. the sales figure in the income statement, and if accounts receivable have increased, we will deduct that increase. If they've decreased, we'll add it. Likewise, advances from customers, in other words, unearned revenue liabilities. If the unearned revenue liability is increased, increase in a liability, you'd add. If it's decreased, of course, you'd subtract in order to get the cash collected from your customers. With cost of goods sold, you'll take the cost of goods sold figure and make two adjustments. First of all, you'll adjust for the change in inventory. Increase in inventory, it's an asset, so deduct it. Decrease in inventory, you'd add it. Accounts payable, again it's a liability, so increase in an accounts payable liability, you'd add the increase. Decrease, you'd subtract it. So notice the adjustments we're making really are the same adjustments that we used under the indirect method. And essentially all that we're doing is we're adjusting the income statement item for that adjustment. But we're using the same rules: increase in assets, deduct; increase in liabilities, add. Okay, so let's get on. Let's actually do the direct method. So what we're going to do is take each income statement item in turn, working down from sales all the way down to net income. So we start with sales, we then move into the balance sheet and look for any asset or liability that relates to that item. We then, of course, look for the change in the balance sheet item and then apply the rule. And notice the rule is exactly the same as we had under the indirect method. An increase in an asset you deduct, an increase in a liability you add. A decrease in an asset, add. A decrease in a liability, deduct. So exactly the same rules as before. So we then take the income statement item and adjust it for the balance sheet change. We can then tick those items as dealt with in the income statement and balance sheet and move down to the next item on the income statement and keep on repeating the process. When we hit depreciation and amortization in the income statement, we can simply ignore it. Now, students tend not to like this, or candidates tend not to like this, because they argue that under the indirect method they included depreciation, but under the direct method they're ignoring it. That is not the case. Remember, we started at net income under the indirect method, so we'd included depreciation. So we added it back in order to eliminate it. Here we're not starting at net income, so we can just ignore it altogether. Exactly the same rule with gains and losses on asset disposals. They were included in net income under the indirect method, so we needed to adjust for them to remove them. Here we can simply ignore them. And we're just going to keep on moving down that income statement until we get to net income, total it all up, and we should have CFO. And if everything's worked correctly, we should have the same CFO that we got under the indirect method. So we're looking for 85,000 in our example. So let's start our process. Starting at the top of the income statement, our sales figure of 200,000, into the balance sheet to look for any asset that relates to sales, and of course it's our accounts receivable. And if we remember from earlier, our accounts receivable had changed from 18 up to 20, 2,000 increase, so deduct. That gives us the cash collected from our customers of 198,000. Down to the next item on the income statement, that's our cost of goods sold of 80,000. Notice I'm putting revenues in as positive, expenses in as negative. Very important that we do this, otherwise our adding and subtracting rules are going to go haywire. So cost of goods sold 80,000. First of all, I'm going to adjust for the inventory. Into the balance sheet, the change in inventory was inventory 14,000 last year, 10,000 this year, $4,000 decrease in an asset, so let's add it. So notice 80,000 negative plus 4,000 gives us our purchase figure, 76,000. So we know purchases are now 76,000. Now into the balance sheet, look for anything that relates to purchases, and it's always accounts payable. So we can see that our accounts payable were 10,000 last year, 18,000 this year, 8,000 increase in our liability, so add. And that tells us therefore that our cash paid to our suppliers must have been 68,000. Down to the next item in the income statement, which is salaries. So let's put our salary figure in of 10,000 into the balance sheet to look for any asset or liability relating to salaries. And that of course is our salaries payable that changed from 16 down to 9, $7,000 decrease in a liability. And of course decrease in liability we shall subtract, giving us the cash paid to employees in the year, 17,000. Our next item of course in our income statement is depreciation. Now we just simply ignore it because it's a non-cash item. So that then takes us to the interest expense. So the interest expense in the income statement, 1,000. Look for any asset or liability. We've got an interest payable liability, 6,000 last year, 7,000 this year. So a 1,000 increase. So therefore the cash interest paid was 0. The next item is our gain on asset disposal. Remember, it's a non-cash item, and even if it was a cash item, it would be a CFI, so simply ignore it. So that takes us down to our tax expense. The tax expense, or the provision for tax in the income statement, is 40,000. First of all, we're going to adjust for the deferred tax liability. So, into our liabilities, deferred tax was 30,000 last year, 40,000 this year, a $10,000 increase in a liability, so add it. By stripping out the change in the deferred tax liability, we're left with tax payable, what we thought we owed the tax authorities. Now, of course, that doesn't mean we paid them, so into our current liabilities, let's see if there's any tax payable liability, and of course there is. 8,000 last year, 10,000 this year, so a $2,000 increase, meaning the cash that we paid the tax authorities must have been 28,000. Last step then is to add all of this up, so 198,000 less 68 less 17 less 28,000, and we get 85,000. So notice our LOS is convert, so it does seem that you could be asked to compute this with some numbers. Right, last few learning outcomes on cash flow statements coming up. Our LOS here asks us to analyse and interpret cash flow statements, including ratios and common size statements. So what kind of things do we need to think about when we're looking at cash flow statements? Well, we've already talked about these already. Do your day-to-day business operations generate enough cash to sustain the business? i.e., is cash flow from operations positive? Are you generating sufficient cash to pay off debt when it matures? because if you're not, then you're going to need to raise additional finance. And remember, we said, look, are we generating enough cash from our day-to-day operations to be able to meet both unexpected obligations and to have the flexibility to take advantage of new business opportunities? Okay, so we're going to analyze, therefore, the sources and uses of cash, looking at where the major cash was generated. Now, CFO, of course, we're hoping is positive. Analysts would argue that cash flow from operation is your sustainable cash. If CFO is negative, then the only way the company is surviving at the moment is either selling off assets and therefore generating cash through its CFI, or raising new debt and equity. So one question we need to ask ourselves is our CFO positive? And if it is it sufficient to cover our capital expenditure? Again, if it's not, it's going to indicate that we need to raise new debt or equity to finance CapEx. Of course, what we also need to look at is what are the major determinants of CFO. Now remember, of course, if the company's used an indirect cash flow statement, the analyst would therefore have to adjust to the direct method. In particular, we're interested in how close CFO is to net income. Why? Because essentially, if net income, particularly if net income is much higher than cash flow from operations, it would indicate that earnings have been generated from the accruals process rather than being backed by cash, and therefore we get poor quality earnings. Again, not only do you want to look at how similar CFO and net income is, but you also would like to look at the variability of CFO over time. Stable cash flow from operation over time means, of course, low risk. Analyze your cash flow from investing. You want to know what this is being spent on. If it's spending it on plant, property and equipment, it indicates, of course, that the company is growing organically. If it's spending cash on acquiring other companies, of course, it's got an M&A type strategy going on. And again, link it back to the management discussion and analysis. Is what you're seeing in the cash flow statement consistent with the strategy that they discuss in the MD&A? CFF, now of course we need to know how the company is financing its capital expenditure and CFO, and of course we can be able to see if it's raising debt or equity. Again, of course, we can see whether the company is raising or repaying capital, and of course any dividends that are being returned to the owners. Now again, remember, it says we also need to be aware or be able to analyze common size statements, and there are two approaches for your common size statements. You can show each item in the cash flow statement as a percentage of sales. Now that's really quite useful for forecasting future cash flows, because then if you could forecast future sales, it would therefore allow you to forecast future cash flows. The other approach is to show each inflow in the cash flow statement as a percentage of total inflows, each outflow in the cash flow statement as a percentage of total outflows. And I've done this essentially for our Eccleston example. Here are the inflows. You can see the vast majority of inflows here are coming from receipts from customers, which is good news. Only a little bit of the company's inflows have come from asset disposals and issuing new debt. Okay, so it's not overly reliant on debt or disposals of assets. When we look at our outflows, again, we can see roughly what percentage of the outflows are from each source. Large amount coming from our suppliers. Notice as well a relatively large amount, 26.3%, due to the purchase of equipment. Now that could be that they're replacing the wearing out of existing PP&E, or it could be, of course, that they're expanding the business. Our next learning outcome says calculate and interpret free cash flows and also performance stroke coverage ratios. So free cash flow is the cash available for discretionary uses. We normally therefore say investing in the firm, i.e. capital expenditure, is non-discretionary. So it's the cash flow after capital expenditure that could be distributed to the providers of the finance. And of course, it's typically used as a valuation metric in valuing companies. Now, there are two measures that we have: free cash flow to the firm and free cash flow to equity holders. Free cash flow to the firm is before any distributions to both debt and equity holders. Free cash flow to equity is after payments to the debt holders, but before any distributions to the equity holders. So essentially, if you forecast future free cash flow to the firm and discount at the firm's WACC, you would get the total firm value, i.e. the theoretical value of both debt and equity. If you compute free cash flow to equity and discount at the cost of equity, you'd get the theoretical value of the firm's equity. So here are our computations. Notice with free cash flow to the firm, the pre-levered figure before distributions to debt or equity holders, we take net income, add back our non-cash charges and subtract the non-cash working capital. Now that sounds confusing, but really all it's saying is compute CFO using the indirect method. We then add back net interest. Okay, now why are we doing this? Because of course we want cash flows before any payments to debt holders, and the problem is CFO has included interest payments. Now if we're going to add back the interest, we need to also add back the tax saving on interest, which is why we've adjusted for net interest. Then of course subtract your fixed capital investment, because we're making the argument that fixed capital, i.e. capital expenditure, is not a discretionary cash flow. Okay, that's our free cash flow to the firm. Let's have a look at free cash flow to equities. Take CFO, again using the same approach, net income, add back your non-cash charges, subtract non-cash working capital, i.e. compute CFO using the indirect method, then subtract your capex, and then add on any net debt increase. If debt's increased, add it on. If debt decreased, subtracted it. Why? Remember, free cash flow to the equity holders is after payments and receipts to the debt holders. So we're going to just do this, as the LOS says calculate, we're going to do it for our company, Eccleston. So let's take CFO, $85,000, add back net interest. Well, our interest expense was $1,000, and remember we were told way back that our tax rate for this company was 40%. We then need to subtract our fixed capital investment, and we're just going to use our CFI as a proxy for this, so $20,000. So that would give Eccleston a free cash flow to both debt and equity holders of $65,600. Let's have a look at the free cash flow to equity holders. Take your CFO, subtract your capex, so $85,000 minus capex, plus the increase in debt, which was $10,000, you get $75,000. Notice we should be able to reconcile between the two, because there are only two differences in them. The fact that essentially free cash flow to the firm has subtracted or added back, net interest, and essentially free cash flow to equity is added on net debt. So if we take free cash flow to firm, $65,600, subtract the net interest, and then add on the net debt increase of $10,000, we would get free cash flow to equity. Here are some of our cash flow ratios. We need performance ratios and coverage ratios. These are fairly straightforward. Cash flow to revenue, CFO over net revenue. It's like your net profit margin, net income over sales, but it's using CFO rather than net income. Cash flow return on assets, CFO over average total assets. So in other words, this is a bit like return on assets, net income over total assets, but it's using cash flows from operations rather than net income. So it shows you how your asset base is generating cash flows. Cash flow return on equity, this is the cash-based measure of ROE, return on equity. So again, you're looking at average stockholders' equity on your denominator and comparing it to CFO on your numerator. How you're using the investors, the equity holders' residual interest to generate cash flows for the company. Cash flow or cash to income, CFO over operating income. Typically we'd use EBIT as our measure of operating income. Again, basic idea is we want these figures to be close as possible. So a ratio of close to 1 tells us our operating earnings or our operating income is of high quality. Cash flow per share deduct preference dividends because they must be paid before a common dividend, and then divide it through by the number of common shares. Now notice, of course, under IFRS, potentially dividends paid could have been taken through CFO, and if they were, you would have to add those back. So if they'd gone through CFO, it'd be CFO plus dividends paid minus preference dividend divided by number of common stock. Our coverage ratios, debt coverage, CFO divided by total debt. It's just really showing you what percentage of your total debt you could pay off if you were to use all of your cash flow from operations to pay down debt. Interest coverage, well, of course, normal interest coverage is EBIT over interest paid. This is just going to be the cash-based version. So take your CFO, unfortunately they deducted interest from that, so add back interest and add back tax and do it over interest paid. Okay, so it's the cash-based version of EBIT over interest. Note again, under IFRS, if interest paid was treated as a CFF, then you're not going to have to add it back because it was never deducted from CFO in the first place. Reinvestment is simply CFO over cash paid for long-term assets, and of course it's looking at how comfortably we're meeting our capital expenditure from our cash flow from operations. Last one's debt payment, CFO over cash paid for long-term debt repayment. Again, it's looking at how comfortably we're making the principal payments on our debt. CFO over dividends paid looks at how comfortably we can sustain our dividends. And then finally, CFO over CFI plus CFF looks to see whether cash flow from operations is sufficient to cover both investing and financing cash flows.